Welcome to the fourth and final instalment of Invest Week, a digital series brought to you by the Australian Investment Council. Yasser El-Ansary, Chief Executive of the Australian Investment Council, will lead this discussion with two industry experts, Gillian Gordon from JBWere and James Martin from Hamilton Lane, about the best way for potential investors to acquire more knowledge and begin the process of researching the opportunities that are available in investing in private capital. Any advice that may be provided in this presentation will be of a general nature and has been prepared without taking into account any potential investors' objectives, financial situations, or needs. You should consider whether the advice is appropriate for you in light of your own circumstances. This discussion is built around awareness of investing in private capital for wholesale investors. That is, investors who would meet the definition of a wholesale client under Section 761G7 of the Corporations Act. There are a variety of ways an investor could be classified as wholesale, one of which would be to obtain a valid accountant's certificate, which confirms that the investor either has net assets of at least $2.5 million or has gross income of at least $250,000 for the last 2 financial years. The accountant's certificate must be from a qualified accountant and must be less than 6 months old.
Well, hi and welcome back to the next instalment in our Invest Week series, proudly hosted by the Australian Investment Council. My name's Yasser El-Ansary, CEO at the AIC, and it's a real pleasure this morning for me to be joined by Gillian Gordon from JBWere and James Martin from Hamilton Lane. And we're going to be talking a little bit today about how we effectively bring the conversation that we've had over the last 3 parts to this series together. How do we bring investment into the private capital sector, into the asset class? If you're interested in the conversation that we've had so far, if you're interested in the opportunities that lie in this part of the market, how do you do that? Jill and James, thanks so much for being a part of the chat today.
Great, thanks Jesse.
Great to hear.
Jill, if I can start with you, tell me why at this point in time, investors who have heard the conversation that we've had so far in this 4-part series, why it's relevant for them now, at this point, to be thinking about private capital. Why are some of those investors only hearing about the opportunity in this space now?
Sure, great place to start. Thanks so much for having me on. I think in terms of what has been preventing clients from getting into private capital, and by clients I mean private wealth investors, is really could be summarised as 2 main points. And those are generic issues that affect every private wealth client, regardless of if they're in Australia or not, and those that I think are quite specific to Australian wealth investors. So if I start with the kind of more generic pieces, I think that's really around challenges in access and challenges in insight. So if I start with access, so usually if you want to access a private capital investment, you have to write a pretty big check size.
Yeah.
And by that check size, probably around $10 million US.
Millions normally, that's right.
So, sadly, a lot of private wealth investors probably don't have 10 million in their pocket. So I think that's one of the big challenges is, the check size. There's also issues around the challenges of the structure and finding access to that structure. There's also challenges around things like operational issues, things like capital calls. And that's really when an investor commits an amount on day one and then is called for that capital over time as and when the fund manager finds assets to buy and put into that fund. And so there's really kind of difficulties around how you get that access and how you get it in a format as a private wealth investor that makes sense to you. The other issue I think is around insights. And that is, there's a lot of challenges in the private markets. It's private by nature. That means there's real challenges around data transparency. It's quite opaque to get a look through to those assets and understand what those assets are and all the risks associated with it. So I think if we take a simple example of a share, you can look that up online today. You can hear all sorts of information about that share, historical data, analyst recommendations. That just simply doesn't exist in the private market.
So is that a problem, Jill? Is the lack of transparency or the lack of an ability to look right through to the underlying asset something you should be frightened of?
I don't think you should be frightened, and I think that's a great word that you used, is frightened. I don't think it's about being frightened. It's about making sure that you have the skill set yourself or that you're partnering with someone to help you to get that right insight and that right research capability and knowing where the risks and opportunities are, so you're making the right decision. Because private capital, as you know, is relatively illiquid, so you've got to make that right decision. You know, you can't just trade in and out of it like a share. So I think that insight piece is really important. And then if I think about, you know, challenges for private wealth investors in Australia, I would say that there's a few unique challenges. You know, 29 years of no recession. If you've had a traditional portfolio that's been kind of 60% equities, 40% bonds, or 70% equities, 30% bonds, by and large, you've done really well for yourself.
Absolutely.
And so you haven't really had this kind of drive or challenge to diversify your portfolio like I've seen in private wealth clients overseas. So the GFC overseas, which it was where I was at the time, the clients felt a lot of pain there. They drove innovation and they drove demand for alternatives, which are private capital investments. So they just didn't really diversify in Australia to the same extent, I would say. And also, you know, there's lots of tax advantages to investing in the public market. So, you know, anyone listening to this, you would know about franking credits. Obviously, they're great things depending on your tax status, and that kind of thing doesn't quite exist in the private market. So I think it's about familiarity. It's about being in an environment that you've had really good returns. But if you want to continue to generate the returns in your portfolio going forward, it is a subdued outlook, so you're probably going to have to think about diversifying your portfolio or going way up the risk curve if you want to generate the same type of returns that you probably enjoyed for the last few years.
Understand that. And James, Hamilton Lane is a global firm. I'm sure some of Jill's points there resonate from a Hamilton Lane perspective as well, that, you know, globally there's been a very different approach to private markets. Here in Australia, it sort of feels as though, consistent with what Jill's just said, we've been catching up a little. Do you think that that is a recipe for significant growth from here? Do you think the outlook for investors in this wholesale space, in the sophisticated investor space, presents huge opportunities here in the Australian space over the years ahead?
Yeah, look, I do think there's definitely good opportunities for local wholesale investors. I think one of the challenges, and Jill hit on a few of them very well, it's, you know, this is a very long dated asset class. You know, the time horizons are very long, and they're very long for very good reason. You know, if you think about fundamentally what private equity is, it's buying a private business, it's looking to improve it and grow it, and then it's looking to sell it at a profit, and that takes time. That takes typically sort of 4 to 6 years or longer. And so the fund structures that have been developed for private equity have been developed with that in mind. And for a lot of smaller investors who don't necessarily have a 10 to 12 year time horizon to make an investment and to manage the capital calls, that is a really challenging thing. The global perspective is an interesting one. I would say that Australian institutional investors have been invested in private equity for a long time. And have, you know, delivered excellent returns for them. But they've been able to do so because that minimum investment size of $5 to $10 million or more, you know, has been okay for them. And when you go into a fund for $5 to $10 million, you might get exposure to 15 to 20 private companies. But even then, you might want to have more diversification by what we call vintage year, the year that you go into the fund. Those things can really determine the outcomes for clients. So you don't just want to go into one fund typically, you want to go into a few. What we have seen, I think, in the last few years, certainly maybe over the last sort of 5 to 10 years, has been an evolution in private equity investing, particularly in the wholesale space. And fund managers, I think, have realised that there's a very large pool of investors who want to get access to the asset class, that want to get access to those to those returns, and they really want to try and do so in a structure which allows for some degree of liquidity, and is not necessarily set for 10 years. So we have seen more of those come to market. We've seen probably 2 or 3 here in Australia. I think the other mechanism that people can use to access private markets outside of those long dated funds is through the listed market. Some portfolio managers have taken baskets or portfolios of private companies, put them into a listed structure, and then the liquidity mechanism that's available for investors is to buy or sell shares in that particular vehicle. And that represents another way of getting access. So I would say that the evolution has been from institutional investors just being able to get access because of their size and their advantages. I think there's more innovation now. There's more structures which are available to investors. And, you know, I think hopefully it provides a good opportunity for people to increasingly diversify the types of investment exposures they're able to access.
Jill, one to you on this. Investing through a listed vehicle that gives you that basket of exposure that James just talked about. From your perspective, are there downsides to doing that? Are there added risks that exist in that context that might be different to, say, investing in some of our blue chip listed stocks on the equities market?
For sure. So I think in terms of what James raised, again, that's a share. It's a listed share. There's some beautiful points on listed in that you can. They're very flexible. They're very liquid. You can trade in and out of them.
Of course, yeah.
But there's a lot of volatility in the public markets, and so by accessing private exposure via listed shares in potentially private equity companies is one way, but they tend to be relatively volatile.
Yeah.
So that's just one thing to keep in mind as an investor. It's certainly one way. There's also a number of fund managers have come to market and put their assets into a listed vehicle,
right, yep.
which allows you to get that access to. That's one other way. Again, I would say buyer beware in terms of there might be a bit of volatility there that you have to be cognizant of.
Yeah.
If you go via a different route, which is more like a fund structure, for example, on the unlisted side, I would say that there's some advantages there for wholesale clients in that you may not get as much volatility in your portfolio, which improves your risk-adjusted return profile, so that's another way, and you may get better look-through to the asset, so you're not as influenced by the listed market, so that would just be something I'd highlight.
Fair enough. Okay. Let's move on then to a conversation about the distinctions that can be drawn between private capital and other strategies and some of the key considerations. So we're working on the assumption here that someone who has been following our discussion over the last 3 instalments of this series is interested in this space. We're working on the assumption that there's something that's uniquely appealing about this private capital unlisted market that is distinctly different from other asset strategies. Let's talk through a little bit, James, perhaps for you to start with. What are some of those key considerations? What are some of the things that an investor who might be turning their mind to this opportunity should really be taking into account? We touched on some of these points a moment ago, illiquidity, we talked about the long dating nature of investing in this strategy. Let's talk through a little bit more about that.
Yeah, look, I think people, when they're accessing private equity, typically they're looking to try and get some different types of exposures in their portfolio.
Yeah.
And there's been a couple of interesting themes, I think, over the last few years with private markets and public markets. One of the themes has been that the public market landscape has been shrinking, and the number of investable stocks for investors to go into, particularly in North America and Europe, has declined. I mean, if you look from sort of 96 through to 2018, the number of public companies in US markets actually declined nearly 45%.
Wow.
And so what that means is that companies that would have gone public, private companies that would have gone public in the past, are staying private for longer.
Right, okay.
And
so
what
they're choosing not to go onto the listed market because there's some drivers for that for them, I assume.
Exactly. Well, I mean, I think there's a couple of drivers. I mean, increased sort of regulatory oversight, the increased burden is one part, but I think the other part is there's a lot of capital in private markets these days, and so these companies don't have to list to generate new capital. But what has been interesting about that is that the dynamics of those particular businesses are quite different, and so if you want to access the growth rates of smaller, faster growing companies, that's increasingly more difficult in the public markets, and there is more of that opportunity in the private markets. That's something we've certainly seen. That's certainly one of the big trends.
Jill, from your perspective, what's driving that value creation in the unlisted space? What's uniquely different about that part of the market that creates that significant opportunity that James is touching on?
Sure, I think there's it's just full of opportunities, the private markets, and I think it's worth touching on. Private markets for private wealth investors can mean many things. So one of the key questions I always get clients to think about is, what are your goals and objectives? If your objective is, I'm kind of income focused in what I want in my portfolio, then there might be a private markets investment that is unlisted that might be more appropriate to you. So that could be something like core infrastructure, core real estate, private debt, but on the highest end of the capital stack. So that's the kind of private markets investment that might suit you. If you're an investor that's listening to this and you're thinking, no, I'm a high growth investor, that's what I'm looking for. I'm not interested in income, I'm more interested in growth. And that's really around what James is talking about, this private equity, also venture capital. And that's, taking a longer term time horizon, and you can really drive value in unlisted space in the private equity venture capital space. And then if you're listening and you're thinking, I'm kind of a little bit of both, kind of income and I'm also a little bit growth, then there's definitely investments that kind of sit in that mid-range, and that would be, you know, moving from say core infrastructure and real estate into core plus or value add, so a little bit more up the risk spectrum, or private debt. But in all of that, from an unlisted perspective, there's really value to be had, and that's around, you know, it drives low correlation in your portfolios. It's pretty low correlated to traditional asset classes like shares and bonds. It's a great way to diversify your portfolio. And like James said, you know, the private markets are growing at a rate that the public markets just aren't. And it really lends itself to innovation. And I think that's really interesting for clients that are looking for ways to diversify their portfolio.
Tell me a little bit about low correlation. You mentioned this concept a moment ago. So what do you mean by that, Jill?
It's a great point. I'm glad you picked me up on that. So low correlation is really about, in layman's terms, it just means, you know, if shares go up and you have low correlation shares, that means you're probably going down or you're more neutral. So you're kind of moving in a different direction. So why it's really important to think about correlation in your portfolio is that's about portfolio diversification and building a well-constructed portfolio. So you don't want all your assets within your portfolio highly correlated, because that means when things are good, they're good, but when things are bad, they're really bad. So that's really important to consider.
Tell me then a little bit more about risks. You know, we know there's immense opportunity. You've both touched on that theme just now. We know that there's some really exciting things happening in that unlisted market. You think about all of the high growth companies. Some of these businesses, of course, have been around for a few years. They've just been pretty quiet. And it's not until they make the front page of newspapers that people suddenly start recognising these brand names and these identities. But tell me a little bit about some of the other considerations from a risk point of view. Let's put on the black hat for a moment, and let's talk about what you need to take into account if you want to move into this space. Jill, perhaps to start with you on this one.
Sure. I think this is the absolute most important point. You absolutely need to understand the risk, and you've got to go in eyes wide open. So to do that, you either have to have the capability yourself, or you have to partner with someone who can give you that capability. And the things that you need to look out for in private markets is you are probably locked in. There is probably limited liquidity. Now, there's always exceptions to this, but in general, it's highly illiquid. And so you need to think about making the right decision. You can't just trade in and out of it. So that is a risk in itself. The structures can be very complex. There can be complexities around the legal structure. There can be complexities around the fee structure. Fees on the assets, fees on the overarching fund. You really need to have the ability to look through and understand that. And I think in terms of just being able to understand what you're getting into, you really need to understand where the look through is, and that's around data transparency. These markets aren't transparent. You really either need to have the access yourself, which is quite difficult as a private wealth investor individually, or really partnering with someone who can give you that research and insight into what you're actually investing in.
It is really important, this point, isn't it? Because we've talked, of course, since the GFC, which was probably one of the key turning points, let's say, from an investment perspective for a lot of people, all of us really, in embedding and instilling and reminding us of all of those basic concepts that many of us acquired through university study, which is understand what you're investing into, right? So James, from your perspective, how does that risk framework, that risk paradigm look from a Hamilton Lane point of view? What are the key risks as you see them when it comes to investing in an asset class like private capital?
Look, I think investing in private capital, you know, it's not without risk, and I think people need to be very clear on that. I think the other part is that diversification is always really important. You know, private companies, you know, even private companies that are run by executed private equity strategies, you know, can fall in value. And so I think that's something people need to be aware of. And therefore, you need to have a portfolio which has a range of investments. You need to have some of those sort of more venture capital, growth-orientated companies. They are typically more risky, and yet the winners there really sort of, you know, outperform.
So it either does really well, or it does spectacularly not so good.
Exactly. So you have fewer companies doing really well, and many that don't do as well at all. And so you want to have an exposure there, but you probably don't want to be overexposed to that part of the market. But then you kind of look up the size spectrum, and you know, even in private markets, it's not all small businesses. You can get some very substantial businesses. You know, in the private markets, you know, what we call the buyout space. You know, mature businesses where they're, you know, growing nicely. They have a long track record of delivering good returns. They're run by good, stable management teams. You know, these can be fantastic businesses. And good businesses, you know, for you to own for the long term. But we would say own a good range of those, from the small to the mid-sized to the large. and be really diversified, and be diversified also by region and geography and sector and industry and all the things that we think are going to make sure that if there's an event that is exposed to one particular sector or industry, you are protected by having investments in other parts of the market.
Yeah, it's something that I've talked a lot about across our industry and probably more importantly outside our industry, in fact, this point that you're making, James, which is that Australia, I think, benefits from the fact that we have, despite some of the popular commentary out there, we actually are pretty entrepreneurial. We have a population of 25 plus million people, but we have 2.5 million small to medium sized enterprises. That's huge. That tells me that we are actually risk takers when it comes to our capacity to give it a go, as we all say, and to try to set something up. But of course, on the flip side of that, from a private capital investment point of view, that's also really good news, isn't it? Because that's the potential candidate pool of businesses. Admittedly, some of those businesses are going to be tradesmen and tradespeople who are, running plumbing businesses and electrical services and things like that. They may not necessarily be the candidates for private capital investment, but gee, there's still an awful lot of businesses in the family business area. You think about generations that have established, businesses in manufacturing or food processing and food delivery, etc. The sectors are pretty wide and varied. Tourism and retail, they're the sorts of businesses, aren't they, James, that create really good potential opportunities for private capital investors?
No, I mean, they really are, and there's a huge amount of private companies. We're also blessed by having some very good private equity managers here in Australia. I think that the challenge for the wholesale and retail investor is typically that the access to those managers is very difficult and very complex, and the information that you can get about those managers is very, very hard to obtain. And then to build a portfolio of those companies is difficult. And so we always say, look, we've noticed now, a lot of advice firms really starting to look and analyse at these types of investments. It does require a particular skill set. Alternative assets are complicated. There's not a huge amount of data available.
So it is sometimes about knowing the right questions to ask, isn't it, as well? It's not publicly available information. I think Jill touched on this earlier. You can't just look it up on the net and do your own benchmarking. It is sometimes about the smarts around understanding what are the specific things that I need to find out in order to make an informed decision about where this particular opportunity sits.
Exactly. Look, it's all of that. It's understanding the private equity firms that you're dealing with. It's understanding the data and the analytics that they provide to you. It's having the skill set to be able to interpret that and to do a good job of really understanding what it is that they're doing. And the other part is getting access to it. And sometimes, you just get better access by doing it through a good advice firm.
Jill, JBWere, of course, provides specialist wealth management advice right across the market to, I'm sure, a very broad range of clientele. Tell me a little bit about the role of a professional advisor in this context. So we know that there's certain unique risks. We know that there's certain types of proprietary information that need to be closely scrutinised, closely analysed in order to make that informed decision. How does a firm like JBWere approach it? And I'm sure JBWere would be very reflective.
I can give more generic,
of course, more reflective of the wealth advice sector more broadly.
Absolutely. I think, again, it goes back to what role is that wealth manager playing for you in terms of getting you the right access and the right insight? And I always go back to that. So in terms of the role that the wealth manager can play in terms of access, I think a good wealth management firm can reach out to the best and the brightest of the private equity or private capital managers in the market and get you the access to the top quartile investment managers. They can mobilise their size and scale and act like a super fund to aggregate client demand and get the best access. So that's really important. In terms of not just getting it, but then delivering it to you in a way that makes sense for your portfolio, a good wealth manager can also break it down for you into bite-sized pieces. So you can actually build well-diversified, multi-manager, multi-vintage, going back to James's point, portfolios. That's really important, that diversification. It's not about just getting one investment and it being huge in your portfolio. It's about many different investments and building well-diversified. So they need to be able to do that. And they also need to be able to bring it in a way that hopefully gives you fee discounts and ways of getting that in a more flexible format than just locked in, for kind of 10 to 12 years. A good wealth management firm can actually do that for you. In terms of insight, I think we've talked a lot about the challenges around private markets in terms of data transparency and knowing what you're doing in that space. A good wealth management firm will have bench strength to be able to do that. They'll have expertise, they'll have research teams that can actually conduct the research on your behalf and highlight all the risks and opportunities across a range of outcomes. And that includes things like ESG and thinking about, you know, aligning it to your personal ethics and principles and values so you know what you're investing in. And that's a really important thematic that's coming through with our client base too. And I think it's also about, you know, building your knowledge as a client is also very important. Do they offer you, you know, thought leadership articles? Do they offer you client webinars? You know, ways for you personally as an investor to come up to speed with what's happening in the private market so you're making informed decisions. It's not just about the access, it's also about the education and knowledge base that we're growing with our clients. So I would look for that if I'm thinking about a wealth manager. They're the two big things I'd be looking for. How good are they at getting me the right access, and how good are they at giving me the right insight that I need to make a good decision for myself.
Right. I think if we were to draw some comparisons, what you're describing there sounds a lot like, in effect, in a more expansive way, but in effect it's very similar to the approach that a large, quite sophisticated institutional investor would take, isn't it? Which is if we were to look closely at the way that any one of our major superannuation funds, whether it's Australian Super or anyone else in that part of the market, they would all have that internal capability. They would have teams of people all day, every day focused on that analysis. And what you're describing, I think, Jill, effectively is creating that capability, albeit that you're bringing in some outside expertise to help you achieve very similar outcome in that context.
Yeah, for sure. And I think in this context, size matters. You know, back to the superannuation discussion, the reason they get that access is because they're very big.
Of course.
You know, and they have the capability. But in this context of private markets and getting that access, size does matter. You know, scale and being able to aggregate demand and being able to get the right access is a size and scale game too. So just to point out that.
That makes a lot of sense. James, your perspective on this?
You know, I think, you know, there's obviously a range of things that we need to consider. The number one thing is people want access to the asset class because historically it has delivered outsized returns.
Absolutely.
And I think that's fundamental. And what's really good about the new structures is that more people can now get access to this part of the market and these types of investments where previously they couldn't. And for me, that has to be a good thing.
Yeah. Let's look into the crystal ball then to try and wrap this discussion up. Let's tie all these threads together. So we've spoken in part one of this series around defining what private capital is, the different sub-strategies that sit underneath private capital with Mark Richardson. We spoke in part two with Dr. Kath Giles, who explained a little bit about the inner workings of a private capital firm and what it's like to be on the receiving end of private capital investment. She's currently the CEO of OncoRes Medical. And then we spoke with Eugene and Margaret, who talked us through the quant side of why it makes sense from a financial perspective to incorporate private capital into your investment strategy from a diversification point of view, from an outperformance point of view, as you just touched on, James. So let's now look into the crystal ball. Let's, you know, you guys are going to tell me what the future looks like for private capital investors here in Australia in terms of the opportunities that sit in this market over the years ahead. James, I'll start with you. What do you think the next few years looks like?
Look, I think if we look at the trends in the market, you know, it is a rapidly growing part of financial markets, you know, particularly with that decline in the public markets, the number of stocks available on a global basis, you are seeing much more capital being allocated to private markets and more opportunities. And historically, private capital has been able to deliver good returns for investors. And I think that's, you know, fundamentally, you know, what people are looking for when they're trying to access the asset class.
Jill, to you.
The crystal ball. I think that investors are going to see a far more democratised space. This isn't going to be the space of the super funds solely anymore. This is actually going to be a space of superannuation funds and hopefully high net worth investors that can get this into their portfolio. So I really see the space growing in terms of innovation around how clients get access. And the scale at which they can get access. And I would like to think in the future, if you're a wholesale client, that you can have this in your portfolio. Again, I'd go back to, you know, what type of objective you have in your portfolio. Is it income? Is it growth? Is it a little bit of both? And finding that right allocation. But I would love to think that, you know, we're moving away from this 60-40 equities, bonds, traditional portfolio construction. And we're thinking about the market. And the market is absolutely not just the public markets, but it's also the private markets, and I'd love to be seeing that more in client portfolios.
Fantastic. Well, that's a really bright spot to park our discussion. Thanks so much, Jill, and thanks, James, for your insights today. As I said right at the outset, this is a 4-part series. We're now at the end of those 4 parts. I hope you've found the discussion to be informative. I hope you've found it to be useful in terms of understanding the role that private capital investment plays in the Australian economy. We've been fortunate to speak to some real thought leaders across our industry, and they've shared their insights into some of the things that you need to take into account. We look forward to joining you again really soon with the next part of our journey towards explaining private capital and sending and sharing with you messages around how you can not only monitor and stay on top of the direction that private capital investment is taking here in Australia, but also the opportunities to be a part of it. Thanks so much for joining us.